world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Welcome to our much anticipated first episode of 2021. And what a start to the year it's been. Last week was a train wreck, as GameStop, which was initially bid up by Redditors in an attempt to punish Wall Street, crashed back to earth when the very free brokerage platforms that purport to democratize investing for the 99% shut off trading in the most active stocks, benefiting hedge funds at the expense of retail investors. As wild as the events of the week were, they're merely a symptom of something much deeper. Latent hatred for Wall Street and the traditional financial system that repeatedly and seemingly unfairly rewards a small number of people at the top. Precisely because of this feeling that the system is broken and doesn't serve users, fintech is flying. Robinhood, Chime, Cash App, Coinbase, Affirm, and Klarna have built insane user bases because they're catering to huge swaths of Americans left behind by the incumbent industry. These companies are the future of retail finance in America for sure. What will their impact be? I'm joined by Lex Sokolin to discuss these topics. Check out all of Lex's work at fintechblueprint.com. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Lex Sokolin. Lex Sokolin, welcome to Rebank.
My pleasure as always. We are in a weird moment. I think the last several years have been a weird moment. Maybe the last 20 years have been a weird moment. But we're in a particularly weird moment, and I'm sure that our listeners have been saturated with a discussion of GameStop and Robinhood and the exposure of financial market structures. But I think we can add to this conversation, and I think we can paint a broader picture of what's going on after all this fintech has come together and has transformed the consumer fintech experience. And so, for context, the very last bit on the GameStop saga is that Robinhood raised $3.4 billion and is looking for another $1 billion debt facility so that they can continue to allow Reddit to speculate on GameStop. What do you think about this whole situation? What is going on in the first place?
All right, so I don't want to jump straight into highest level concepts. I think that a little bit of context is still useful. I'm sure that you're right that a lot of people listening to this have been following closely. In fact, they've probably been investing, or more likely their kids have been investing, their middle school and high school age kids. So, this is it's effectively call it continuation, but a very extreme continuation of the idea of kind of distributed thinking, power back to the people, using the internet plus good, cheap technical infrastructure and technology products, which in a sense democratize access. And in fact, we've been talking about democratizing access to financial services and investing in banking probably for a long time, certainly since 2008. When the problem was, concentration of effectively power and decision-making and risk-taking, bad alignment of interests, and too big to fail. And that was followed by the anti-1% movement, Occupy Wall Street. And where my mind goes directly in watching all of this, and I fully understand why this is so fascinating. I tend not to be the type that, that watches car wrecks with great excitement, but there's something about this which I think is more than just immediate carnage. I think it's something of a, I don't want to call it a watershed event, because I don't think the event in itself is what's going to cause change, but I think it's a very strong indicator of much deeper shifts in financial services that pull together so many of the topics that we talk about, which is better products for retail users, better technology, better access, cheaper access, and all of that kind of coming together to challenge incumbent market structures effectively.
Yeah. So to your point, let's just lay the bricks. GameStop is a physical retailer of video games, often used video games that lots of 80s and 90s kids grew up with and loved. GameStop has a horrible business in the same way that Blockbuster, or Barnes and Noble or Borders or Kmart at this point have a horrible business, which is it is not the Epic video game store or the Steam video game store where the action really is. Therefore, if you are a quote unquote serious financial investor and run a multi-billion-dollar hedge fund, you go out and you say, I'm going to short GameStop because it's going to die like the rest of these terrestrial mall shops. And that goes well until a Redditor sees your position and realizes, not based on the fundamentals of GameStop's economics, but on just the sort of the amount of exposure you have to the stock and the mechanics of shorting, where you need to borrow the stock in order to sell the stock and make the price go down. This person realizes that it's possible to create a short squeeze or an artificial price increase against the person with a short position who's paying interest, who's generating losses and getting margin calls. And so not only does this Redditor invest, but also the entire Reddit forum of Wall Street Bets backs this idea, and people start to do this short squeeze by the millions. Other hedge funds realize that, come on, the fundamentals don't work, and continue to pour money against, say, the common investor, which only pisses everybody off. And then the Reddit movement is less about GameStop, and it's much more about just the anger and resentment from 2008 that people have held, through these very incendiary presidential administrations and so on, and it becomes a symbol. And so people through the internet self-organize to send a financial message and basically overpower the tug of war with Melvin Capital and some of the other backers like Steve Cohen and so on. Now, what do they use to organize? They use social media. What do they use to trade? Well, of course, they use Robinhood to trade.
Perfect name, right? Perfect name. I mean, designed for this, built for this, right?
It's just so funny to me because, and I've said this elsewhere, but it's, Robinhood is not Wall Street. Robinhood is a Silicon Valley company to the bone. This is not about Robinhood and Wall Street. Like the two are just different. And Silicon Valley, gives away things for free and then monetizes the users on the back end. And so Robinhood sort of take from the rich and give to everyone mantra, not a really good fit for this particular Robinhood, because this particular Robinhood takes the rich and sells to the rich all of the retail order flow so that hedge funds can place orders within it, or we can have a whole separate conversation around that.
Yeah, it's the classic if you're not paying for the product, then you are the product. And I think that applies to retail investors on Robinhood.
Yeah, and look, this is not nefarious. Like, advertising is not nefarious. It's just a business model that sucks for the consumer. And similarly, selling order flow doesn't have to be nefarious. It's just you have to understand what it is that you're getting into. I mean, maybe just go to another broker that doesn't sell order flow, and it's your choice.
Yeah. But specifically this, right? Like, I do want to dig into this point because I think it's so relevant. So from memory, you were the one who called it out to me a few months ago about it was 100 million plus, I think, that Robinhood had generated in one quarter, maybe, in basically revenues associated with the order flow / anonymized trade data and trend data, I guess, that they were selling to basically hedge funds and high frequency trading firms. Am I remembering that correctly?
Yeah. So the numbers are quite severe. Robinhood probably made over $1 billion in order flow payments in 2020. Now, if you dig into the market structure, again, it's not really that. It's not nefarious. It's just market structure. So, you've got the exchanges, like the NASDAQ or the New York Stock Exchange. And on top of those exchanges, you have market makers, which make sure that there is a market to buy and sell various securities. And one of those market makers is Citadel Securities. Virtu Financial is another company. And if you talk about high frequency trading shops and things of that nature, they're basically on top of exchanges taking orders. And the way they make money is they take spreads. So they take a tiny spread on everybody's transaction. Now, if you're in that business, you're not taking a long or short position. You just want to execute the trades, and you might pay 10% of your P&L to purchase order flow because you get to keep some of the spread. You can have sort of more cynical reads. I don't agree with all of the cynical reads, but you could say they're buying order flow in order to front run it, which is a conspiracy. Or you can say, which I do believe, they're buying order flow so that they can hide larger trades in there. They can put block trades, a $50 million trade of Apple without impacting the stock market. You can basically place into a stream of a giant stream of retail payments. And so for a market maker, paying Robinhood to be the lead gen makes a lot of sense. And again, you can be cynical with it. You can be conspiratorial with it. It's just today's market structure. And so that's where all of Robinhood's economics essentially come from.
I think given the history, right? Like dating back to 2008 and, way before that, the onus is on us in a sense on, the financial industry and, these larger players specifically to kind of engender confidence that what they're doing does make sense for everyone, and it's not self-serving, and it's not purely self-interested and profit motivated in ways that are manipulative. I don't tend to be the kind of frontline revolutionary in a lot of this stuff, but I absolutely understand the frustration of the retail investors, and I think maybe we get back into it by picking up the story and how things evolved. But basically what happened is that due to, again, these market structures and specifically clearinghouses and collateral requirements at clearinghouses, these same quote unquote democratized platforms that were allowing retail investors to access stocks like GameStop to begin with, then basically had to shut down the ability for retail investors to build positions. This run-up fueled by the Reddit forums, as you're talking about, and the free stock trading platforms, which is squeezing to the point of near bankruptcy, in some cases perhaps bankruptcy of hedge funds that are short the stock. Effectively, the run-up gets artificially cut off because access to new buy orders is cut off for retail investors. So the people that are driving this run up, the people that are putting money into these stocks, are effectively prevented from continuing to do so, which then gives oxygen back to the hedge funds on the other side, who took the opportunity to effectively recover, and then as expected, at some point the valuation of the company returns to at least some semblance of normality, meaning that retail investors take losses, at least that those who were still in the stock, and the hedge funds are quote unquote bailed out. And sure, you talk about it's the market structure, it's the way things are designed, and they're designed this way because it's supposed to help everything work better, and it's supposed to help limit systemic risk. And the whole reason that this happened is because of these collateral requirements at clearinghouses, which are intended to ensure that large brokerage firms, like Lehman back in the day, and this time Robinhood and others, don't go out of business, causing knock-on bankruptcies and instability across the industry. But now, perhaps we get to the bigger question, which is, in a sense, like, is this inherited market structure from the past? Is it the right market structure? Will it continue to be the prevailing market structure going forward?
Sometimes people will say kind of market structure as a flag for this opaque industry value chain. And I think in this case, we can have a very reasonable intuition of just what's going on. That is not a nefarious intuition, but which still creates outcomes that makes people feel like the oligarchs always get to win. And so why does the DTCC, the clearinghouse, which is where all of these equities live, why does it need collateral? It needs collateral because trades take 2 days to quote unquote settle. Everything else is sort of a rearrangement of paper. The truth is at the clearinghouse, the truth about who owns what. And so if it takes 2 days for a trade to complete, for the equity to transfer ownership, for the cash leg, the cash piece to move from one person to another, and everything to kind of check off and get reconciled, and it takes 2 days to do that, you've got 2 days of risk. You got 2 days of, if everybody dies, who owes what to whom? And Lehman, and Bear Stearns, and almost Merrill Lynch had these death or near-death experiences as a result of that gap, that time of uncertainty. And therefore, like you said, there's an insurance pile. You basically keep money at stake as collateral to have your brokerage house be alive. And the moment people think that you're not going to be alive, they're going to take that collateral. And if you don't have enough, you're dead because you're overlevered and so on. And so Robinhood raising $3.4 billion, on the one hand, it's like, oh man, these guys sure know how to fundraise and grow a profitable business. The other take is, oh man, if they don't have $3 billion to put up because they have 10x the collateral requirements for DTCC, they're dead. Now, from the outside, we can't. It's hard to know. It's hard to tell. But it's up to our audience to drive to their own conclusions. So, as it relates to modern market structure, at this point, I'm pretty self-radicalized about the answer. But there are the real-time trade settlement systems. Blockchain's been talking about changing collateral management and clearing and settling now for nearly 5 years, and lots of people roll their eyes about why would an industry want to strip out what works, quote unquote, and put in something new. And so it's been very hard to actually.
And I guess the answer based on this specific series of news events is that it doesn't work, right? Or hence there's opportunity for improvement.
Yeah, and it's the sort of caricature, the cartoon that I've drawn about it before is, you can't build a Spotify of CD-ROMs, which is what Robinhood is. If it uses DTCC and every single broker, it's not just Robinhood that turned off the trade button. It was also TD, Ameritrade, and it was E-Trade, right? All the brokers that are in this game. Robinhood just happens to have the most cognitive gap between its promise to its users and its behavior. So we do have answers in the shape of blockchain-based market infrastructure, and the clearest sort of test of that is decentralized finance, which has not waited for equities and has just created its own digital assets. And I believe Uniswap, the decentralized exchange, had $60 billion worth of volume that's traded around without, all real time settled. There are lots of problems in DeFi to be discussed separately, but I think this example is just so educational for what doesn't work about the current setup.
All right, so let's use this as an opportunity to pivot into the larger point, which is a point you were making to me right before we started recording. Do you want to dive in and summarize it?
Yeah, let me tee it up as both a rhetorical statement and a question as to what you think. So there is a new American finance forming. We know what the new Chinese finance looks like in the shape of Alibaba and mobile payments and all that. We have not known what the new American finance looks like because the Betterments of the world, the SoFis of the world, despite being nice, solid businesses, did not seem to be too upsetting to the BlackRocks and the Vanguards and the Goldman Sachses. But I think what we see now is finally an emerging new American finance. And so what does it consist of? It consists of fintechs, B2C fintechs, that have all footprints of over 10 million users, right? So you take Robinhood, you take Chime, which is now over 12 million people. You take Square and Stripe and Affirm. And of course, Coinbase with its 40 million people. And to me, this collection of 5 to 10 companies represents the formative experience for anybody between the ages of 8, to 25 interacting with financial products today. And so I think it's starting to coalesce together. And the question, I guess, is, what does it look like in 5 years? What is the average person just going to live inside of this ecosystem? Do you see that happening, and do you see any pitfalls?
Okay, I'll try not to jump straight to the second part of your question. But look, in terms of the first part of the question, I mean, this is everything that we as fintech have been talking about since the very beginning. This is finally hey, there are much better tech and software solutions to solving all these traditional finance problems. And specifically, I think what we're talking about is the set around, retail finance, and specifically the quote unquote last leg, where users actually interact with these companies and these products. And in my mind, I kind of split it into two pieces. One is basically providing access or products or tools or whatever to previously unbanked or underbanked. And I think that Chime and Cash App are doing a ton of work in that space. And I'm very hopeful that on-ramp for large numbers of people, you talked about Chime now having 12 million customers. I hope that becomes an on-ramp to a better future, to more opportunities, to continued financial education for everyone, and eventually to long-term financial well-being to everyone. I hope that doesn't become an acquisition channel into high-interest lending, credit cards, and things like that.
Can I just pause you here on Chime? Sure. Because I think you're much deeper on them than I am, and they've really broken away. In the way that Square has broken away from Venmo in tapping into payments and really tapping into culture and influencers to drive payments. Chime has broken away from nearly every other attempt in the US at a neobank. They're ahead of MoneyLion. They're ahead of Aspiration. They're ahead of really anybody else who's tried to do the same. Why? What is it that they do that you think works?
I mean, this could probably be a 50-page research report and, a series of financial models and various other things. But if I, distill it in my own mind down to two things, it's great technology and savvy marketing. Of course, great technology subsidized by the non-Durbin uncapped interchange, which everyone was using and is using. So it's not like that was unique to Chime. But I think they did a great job of capitalizing on a market opportunity, building great technology, communicating, a value proposition to customers, tapping into a segment that was underserved. And then very quickly from there, raising tons of money, including from some influential people, and turning that money into a very, very, very effective national marketing effort. So everything from sponsoring the Dallas Mavericks to TV commercials, they've just done an amazing job of getting their brand out. And then I think, there's also a component which is specific to the product set. And I'd have to dive back into it and refresh my memory a little bit, but the combination of get paid 2 days early, which they were one of the early companies to do, certainly at scale. And I think they have basically like kind of an overdraft alternative, free overdraft alternative. I think that combination really, really resonates and solves a lot of problems for a large number of people in America.
It just always boggles my mind what works in the States. Just the kind of national population and the kind of average financial situation you need for a overdraft financing product to be a core driver of neobank adoption. It's almost tragic, right? Because overdraft protection is a loan for when you don't have enough money, and to have so many people that are living always on the edge of needing just a little bit more money than they have. I mean, that is tragic at scale. And Chime's got 12 million people who benefit from this. So I do think it's, kind of going to this concept of a new American finance, where you have the Chime users who are, on the edge. And then you've got the Robinhood users who are, we know from the Melvin Capital example, right? Just like how much resentment there is against Wall Street and the hedge funds. It's a scary power. It's really a whirlwind.
Yeah. And I mean, if we look at this from the most hopeful, the most optimistic standpoint, like Chime and Robinhood, and I think the other companies that you've mentioned that are really, really scaling fast now, are providing that alternative that I think people, again, at least since 2008 and probably before, have been craving. The reason that people have been so angry for so long, and again, game a la GameStop, it's still there, is because the existing offerings, the existing marketplace, the existing industry doesn't serve their interests or meet their needs. So there's, that simple stat, right, that gets thrown out all the time. And I think there's actually some improvement has been made from the version that continues to, or at least originally caught headlines, that something like 50% of Americans don't have $400 in savings. Like, if for that stat to be true, something is broken, and I think Chime and Robinhood and Square and these other companies you mentioned are part of the solution, or at least they have a huge opportunity to be part of the solution. I think they filled a space in the market, and they filled it with products that people need. Now the opportunity, if we're to move beyond the, in many ways, as you mentioned, stressed situation, financial situation for a lot of Americans, the opportunity is to turn that into financial education, financial literacy, better access to credit in ways that serve users, and eventually long-term financial well-being. Right? It's not to turn that into high-interest credit cards and unsecured consumer debt and types of traditional financial products that kind of got us where we are now in the first place?
I hold. I guess I was professionally raised in an asset allocation diversification environment, and I've internalized the importance of financial planning in the wealth management space, the importance of risk-adjusted returns, the damage that speculation can do to achieving goals in the long run, the problems of lotteries and options and all of these things. And so it's a weird moment, right? Because I look at what's quote unquote popular, and it's a lot of moonshots. It's a lot of underwriting debt. It's a lot of kind of speculative trading, whether it's Tesla or crypto. And I think it reflects the financial situation that the country is in. And I think one of the biggest symptoms is Coinbase. And I think in 2012, if you were to ask me this question, I would have gotten it 100% wrong, right? So is the future of American asset management or wealth management, is the future of that something like Betterment or Wealthfront, which is floating at 25 or 30 billion of assets? Or is the next generation going to be buying digital assets on Coinbase, which is now at 90 billion in assets? And of course, the answer in 2012 would have been Betterment or Wealthfront, and it was wrong. The answer is clearly Coinbase with its 40 million users and absolutely astounding rise to what is likely over $1 billion in revenue last year, and an IPO that's going to, it's not an IPO, it's a direct listing on the NASDAQ that's going to hit this year. And I think in the private markets, Coinbase is trading around 50 billion in enterprise value. And I think it's just as big a symbol of the change in the underlying consumer preferences, as you can look for. I think it's a super bright signal. But I wonder if I've just self-radicalized, if I've persuaded myself of this happening, or whether you think that's right and you see it as well.
Okay, so it's extremely difficult to argue with reality. And the reality you just laid out. Questions I would ask are around the kind of, I don't want to call it problem to be solved, but like what is the point of investing? And like what goals are people theoretically trying to achieve by investing? And then what are therefore, given all those inputs, the best ways of doing that? And I think it's very clear that kind of over intellectualizing, just gets you to either the kind of like private wealth model where there's this like asymmetric information setup, which results in high fees, or the assumption that super complex, self-rebalancing passive portfolios are like the only or the optimal solution. I think all of those, both of those things kind of take less account for the human psychology maybe than they should, And I think if you only account for the human psychology, then it's easy to get to speculation. And I think especially if you look back over the past 10 years of basically like, maybe it's more than 10 years now, kind of like stock market bull run, especially in technology. I mean, I think like you and many who are surely listening to this podcast, am totally convinced that the future of finance and the future of the world is digital, increasingly digital. And so it's tough not to view all the companies that are doing great work in that space as being highly valuable, even on like a discounted cash flow basis, traditional investment valuation type basis. That said, the world moves in cycles, and ideally we collectively should be accounting for these things, and not just, I guess, looking for investment solutions that that happen to be high performing over the past few years. God, I sound like my dad.
We're all our dads at this point. Look, I did a write up on this topic earlier this week, and it got picked up by Zero Hedge, which is exciting to get the exposure. But then I looked a little bit more into the demographics of Zero Hedge, and it's like the anarchist, libertarian, right-leaning sort of internet wave, the same part of the Reddit wave, with a perma-bear point of view on the economy, which is that the Federal Reserve is overprinting money, which it's hard to argue with on the one hand because of the $3 trillion last year. On the other hand, nobody's spending that money because inflation is not going up. Instead, they're putting it into capital assets like the stock market and certainly into crypto assets. And so that leads to the conclusion of these inflated prices and kind of a wealth effect and a disconnect from quote unquote fundamentals and a manipulation of the machinery of money. And I just found myself articulating these views, which maybe are conspiratorial, and I worry that I'm sort of falling off the cliff a little bit in my points of view. But it definitely feels like the price levels of everything are super high, and thinking about risk-adjusted returns and thinking about the long term would really serve investors well, especially as we kind of pick up these topics of financial health and financial literacy and so on. So I guess the balance is for this new American finance on it has democratized access. Everyone's got everything for free now, from credit to trading and so on. But it also creates this whirlwind, this kind of Twitter version of financial services. Look,
my takeaway from this conversation and the events we've observed recently, are that they're just clearly such strong underlying forces here, which make it very clear that things, need to and will move in different directions than they have in the past, and it's tough to perfectly predict, I guess what's going to be new versus the kind of age-old adage of history repeating itself and kind of reversion to the mean, especially around all things economic. But it fundamentally feels like things will continue to look increasingly different in the future. As in, using whatever like 1990s or early 2000s frameworks to think about retail finance, investments, banking, the whole kind of financial services universe. I feels very limiting.
Totally agree with you there. I think it's definitely a wake-up moment for a lot of the traditional financial incumbents who are serving these customers, or different generations of these customers. I think the one place that a lot of institutions often go is they start talking about the institutional client segments and wholesale business and the large capital markets machinery. And I think it's important to understand that that machinery, that capital market structure, to make big funds and to do trades with other institutional money managers, that is all a value chain that, end of the day, ends up benefiting some particular individual, whether it's a holder of a 401k account or a holder of a deposit account. Even our kind of high-end institutional finance feeds and stops at the end with people. And so we have to very closely watch what people choose, what systems they prefer, and what incentives they like. Thanks so much for joining me for this conversation, Will. Fascinating stuff.
Thank you, Lex. This is great.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.